Hi, it's Peter Hodson from 5i Research. We've got the top 5 most asked questions on our website this week. The first question is, should investors be worried about the emerging market situation? So we've got Argentina, the currency's collapsing, Turkey, the currency's collapsing, and it's set off a contagion across the Asian market, and people are concerned about China slowing down and what's happening in the emerging markets, and should they be concerned about their North American portfolios? Simply, the answer is no. Every couple of years, the emerging markets go through some sort of crisis. Argentina has gone broke more than once in the past 20 years. The other currencies have a flight to quality. People are moving back into the US because they're concerned about the emerging market economies, but that does not mean that there's going to be a trickle-down effect into North America. In fact, it means perhaps that valuations in North America will increase if people are worried about the rest of the world. So China remains a bit of a problem. We want to see China growing again, but in terms of Turkey, Argentina, and the rest of the emerging markets, you really don't need to concern yourselves too much, unless you, of course, you're invested there. But other than that, if you're a specific local investor, be concerned. But for North American investors, don't need to worry. Okay, next question. We get a lot of questions about the REIT sector, and specifically, people have asked us this week, is the REIT sector still worth buying? So real estate investment trusts, of course, they buy properties and they spin off the cash flow to investors. Last year, around June of 2013, the sector just got totally decimated because of fears about higher interest rates. So for about 8 years, the sector was just an absolute winner, straight up, and you were making 8% interest plus capital gains. And then it all reversed literally overnight as people started to envision higher interest rates and the offsetting impact to that in terms of REIT growth and REIT payouts. We've had a couple of REITs cut distributions, but on average, the sector's okay for income. There's nothing wrong with the sector on average. GDP growth is pretty good, occupancy rates are pretty good, rents are going up, and some of them are doing acquisitions that make a lot of sense. Payout ratios are always high in the 95 to 100% payout ratio. That's how REITs are structured. But if you're an income investor, you do not need to panic. What we saw last year, a lot of people had too much exposure in the sector, 20, 30%. We don't recommend anybody have any sector at that high, but for a 10 or 15% exposure to the REIT sector, if you're for an income investor, you'll be quite fine. Next question. We always are kind of amused by this question. The question is, should I sell everything now and wait for a pullback? We get this question a lot from investors who are looking at the media. They're concerned about the declining market. Last year was great. This year we're down 5% already this year, and people are, for lack of a better phrase, freaking out a little bit. Basically, if you know exactly when you're going to buy back in, by all means, sell everything now and buy back in at the bottom. But I have yet to meet anybody who knows how to do that. The market cannot be timed so effectively. If you have good companies, they will be good companies tomorrow, and they'll be good companies next week. And even in a bad economy, they'll be good companies. So it's a question of your risk adjustments. If you're comfortable with your risk in the market, do not do anything, do not panic, and you're going to be there when the market goes up. If you're uncomfortable with your exposure and you can't sleep at night because of what's happening, then you have to take some off the table. But don't try and sell now and buy back at a better time, because A, that time may not happen, and B, you just may miss a huge bull market run, which could happen at any time as well. So it also sets up trading costs, taxes, and it's just more of a timing issue, and we wouldn't recommend it at all. Another question we've got recently from a lot of investors is the gold sector recovery real? The gold sector got decimated for 3.5 years. Last year, there were companies that were down 60, 70, 80% as investors just completely abandoned the sector. Gold had its worst yearly decline in about 31 years. The sector was just hit hard and nobody cared. Nobody could raise money, and a couple of companies went bankrupt in the sector. So now in early part of 2014, the sector's had this huge recovery. I could give you stocks like Detour Gold that are up 76% so far this year in 2014. And a lot of investors are saying, okay, well, is this it? Is it over? Has the bottom been reached and we're back on track? And I think the short answer is probably. It's a bit of a cop-out answer, but I think the sector has turned. You've got investors who are looking at it again, but more importantly, you're seeing companies do financings. Companies are able to raise money this year, where last year, investors and investment bankers just would have laughed at a company trying to raise money last year. You've also seen some merger and acquisition activity. We've got the Goldcorp bid for Cisco. That's positive for the sector overall. And effectively, you're starting to see a little bit of money flowing back into the sector. It's not a full-on green light, go back, go crazy, it's going to go straight up, but I think the worst is probably over, and I think the sector will probably do a little bit better in 2014 and certainly off to a good start. And our final question is from investors that we've gotten the past couple of months is, what are the prospects for growth in the stock market this year? Stock market's had a pretty good recovery. The Canadian market has been less robust than the US, and a lot of people are just basically saying, what's it going to be like this year? Of course, we can't predict the future, but we can predict a couple of things. Earnings. Earnings are looking very good from corporations. You're seeing cost reductions result in higher profit margins. You're seeing higher revenues. You're seeing better debt situations on balance sheets. You're seeing lower interest rates. So earnings are still quite good. So far this year, some companies have reported. It's pretty early in the season for reporting. But most companies have beaten their earnings expectations. So there's still growth from earnings. The other thing that really drives the market in terms of its forecast and its outlook is interest rates. Interest rates may creep up, but they're not going to spike up. The economy is not in a situation where governments have to raise rates, and in Canada actually they've indicated that we're more likely to see lower rates in 2014 than higher rates. So the two main drivers are very positive. Earnings are strong, rates are low. The other thing that drives markets are valuations. What are investors willing to pay for stocks? As we come out of the 2008 problem, the memory of 2008 starts to fade away. We've had a few good years, and investors are generally more confident. So that may get an increase in valuation of the earnings that are coming from companies. So valuations could improve, earnings are good, interest rates are low. It's not a scenario where bad things are expected. Of course, there's always problems that could happen any time, but in terms of forecasting what corporations could do, it's probably going to be a decent year. We think bonds will continue to be sold and invested in stocks, and overall I think the market in both the US and Canada will be pretty good, and perhaps more so in Canada. We've got a long way to catch up to get back to the US's returns from last year. Thanks for watching our video. If you have more investment questions, go to 5iresearch.ca. We have 14,000 questions that we've answered for investors. We have model portfolios and company reports as well, and we're here to help you.